Okay, let's jump right into this explainer. Today, we are putting IDT Corporation through an absolute masterclass gauntlet. We're going to act as expert investment analysts, taking raw financial data and running it through the exact frameworks used by legendary investors. So, if you've ever wondered what happens when textbook investing theory collides with real-world market data, well, you're definitely in the right place.
Here is our agenda. We'll start with a quick company snapshot. Then we'll look at IDT through the lenses of Warren Buffett, Peter Lynch, and Benjamin Graham. After that, we'll run some modern DCF models, and finally, wrap it all up with a synthesized verdict.
Section 1. The Company Snapshot. Let's establish our baseline and figure out exactly what kind of business we're dealing with here.
So IDT operates in a mix of telecommunications and fintech. They've been around the block, recently celebrating their 30th anniversary, and they've been doing a really solid job of expanding their recurring revenue streams. They are pushing heavily into network-reliant services and have consistently proven they know how to generate cash.
Right now, the stock is sitting at $65.86. This price is super important because it's going to be our anchor for everything we do today. Every valuation we calculate will be compared straight back to this real-time market expectation to see if we're getting a margin of safety or if we're just drastically overpaying.
And setting the stage, IDT sits on a really strong foundation. We're looking at a $1.63 billion market cap. And check this out, absolutely zero long-term debt. The revenues are growing, hitting $315.71 million in the third quarter with a diluted EPS of 87 cents. Seriously, keep that zero debt figure in the back of your mind because it's going to be a massive factor moving forward.
Section 2. The Buffett Lens. Time to swap our glasses and evaluate IDT for fundamental quality and economic moats.
We know Warren Buffett looks for consistent earnings, sky-high returns on equity, manageable debt, and a strong margin of safety. So, the big question is, how does IDT stack up? Would the Oracle of Omaha see a wonderful company at a fair price, or is it just a fair company at a wonderful price? Let's run his checklist.
Assuming an annualized net income of $86.5 million over their $357.9 million in equity, we get a really impressive 24.1% return on equity. Combine that high ROE with healthy owner earnings and literally zero debt, and we are hitting major check marks for Buffett. He would absolutely love this squeaky clean balance sheet. But to get his required margin of safety, Buffett usually demands a steep discount to intrinsic value. So while he'd respect the business quality, he'd likely sit on his hands and wait for a price drop closer to that $50 or $60 range to ensure he has a protective buffer.
Moving on to Section 3, the Lynch Lens. Peter Lynch is all about growth at a reasonable price, and he closely watches what insiders are doing with their own cash.
Lynch famously relies on the PEG ratio, that's price to earnings divided by the earnings growth rate, to make sure he isn't overpaying. A PEG of exactly 1.0 means you're paying a totally fair price for the growth you're getting. Anything significantly above that, well, it means the stock might be priced for perfection.
Looking at the Q3 data, IDT has a PE around 18.9 and modest earnings growth near 5%. That gives us a PEG ratio of 3.78. That is way over his ideal 1.0, making it an expensive stalwart or slow grower in Lynch's eyes. Sure, the balance sheet is flawless, but institutional ownership is a bit of a tug-of-war right now. 103 institutions added to their positions, while 116 decreased.
But guys, here is a massive red flag for Lynch. Over the last 6 months, insiders executed 13 sales and absolutely zero purchases. And we aren't just talking mid-level management. This includes heavy selling from the CFO and COO. As Lynch always said, insiders might sell their shares for a million different reasons. Maybe they're buying a house or paying for college, but they only buy for one reason. They think the stock is going up. With zero buys on the board, Lynch would likely stamp this as a solid sell.
Section 4. The Graham Lens. Let's strip away all those rosy growth assumptions and look purely at deep value through the eyes of Benjamin Graham.
So IDT easily passes Graham's tests for adequate size, financial health, and earning stability, but it completely fails his valuation multiples. It carries a PE over 15 and a price-to-book ratio of around 4.5. Graham famously wanted to buy a dollar for 50 cents. He demanded low multiples to protect against the unknown, and IDT's current multiples are just way too elevated to pass his classic defensive investor checklist.
If we extract the total equity to find a book value per share of $14.39 and annualize the Q3 EPS to $3.48,
Graham's intrinsic value formula calculates a fair price of just $33.56. That formula, taking the square root of 22.5 times EPS times book value, is famously unforgiving. With the stock currently trading near $66, Graham wouldn't just pass on this, he'd likely run the other way.
All right, Section 5, DCF and other models. Let's see how modern quantitative cash flow projections hold up against those classic frameworks.
Using a 5% weighted average cost of capital, which is basically the minimum return investors expect, our base discounted cash flow model values IDT at $84.69. That suggests it's actually undervalued right now. But when we look at comparable multiple models like EV/EBITDA and PE, they tell a much more pessimistic story, dropping fair value all the way down into the low 40s. The dividend discount model also points to a downside, landing at $53.57.
And this chart brilliantly illustrates that wild divide. Pure cash flow projections suggest significant upside, while market comparables warn of steep downside. If IDT can actually deliver on those cash flow growth projections, it is a steal at today's price. But if the broader market insists on valuing it like its telecom and fintech peers, you're staring at a pretty massive haircut. Finally, Section 6. It's time for our synthesis and final verdict. Let's combine these wildly different valuations into one cohesive takeaway.
Okay, here is our final scorecard. Graham and Lynch are hard sells at this price. Buffett would likely hold out for a market dip. But pure DCF analysts would be screaming buy. The contrast here is just incredible, isn't it? Intrinsic value models based strictly on future cash flows absolutely love this stock, but the historical, asset-based, and growth-adjusted frameworks are flashing bright red.
Ultimately, IDT is a fundamentally excellent business. You have a company operating with a fortress balance sheet, zero debt, generating high returns on equity, and actively growing recurring revenues. It's a phenomenal cash-generating machine. But you are paying a premium for it. And the very architects of that machine, the insiders, are currently taking their chips off the table.
Which leaves us with a fascinating question to wrap up this explainer. When quantitative models clash directly with insider behavior, where do you put your money? Do the mathematical models see a long-term reality that the market hasn't fully priced in yet? Or do those 13 insider sales tell us that the people with the absolute best data believe the stock has peaked? It is the ultimate test of spreadsheet theory versus human reality. Thanks for joining me on this valuation masterclass.